Do you have company stock in your 401k at Fidelity? You might be sitting on a hidden tax advantage called Net Unrealized Appreciation, or NUA. In this video, I'll break down how it works and how you can use it to save thousands in taxes. NUA is the increase in value of your company stock inside your 401k. For example, if your stock cost $10,000 and is now worth $50,000, that $40,000 gain is your NUA. When you retire or leave your job, you have two choices. You can roll everything into an IRA, but every dollar you withdraw later is taxed as ordinary income. Or you can move the company stock directly to a taxable brokerage account using the NUA rule. With NUA, you only pay income tax on the original cost and capital gains tax later when you sell the stock. Let's say your cost basis is $10,000 and your stock is worth $50,000. You pay ordinary income tax on $10,000 and long-term capital gains tax on the $40,000 gain later. That's the power of NUA. It helps you shift most of your tax bill into a lower bracket. In Fidelity's 401k or net benefits platform, you'll see Net Unrealized Appreciation next to your employer's stock. It shows your cost basis, market value, and the NUA difference, helping you decide if this strategy makes sense. Before making any moves, consult your tax advisor. But if you have big gains in company stock, don't overlook NUA. It could save you thousands in taxes. If you found this helpful, hit like, subscribe, and share it with anyone planning their retirement.